There's always short covering involved, but I don't know that you want to necessarily, pin it on something, artificial or fleeting. The market has been under a fair amount of stress. I do think somewhere in the middle of the day, we got to at least a minor sense that the rest of the capital markets were in full freak out mode when you had the 10-year yield go to 2/3 and credit spreads were blowing out. I still think that you shouldn't expect the market to kind of pick itself up and shoot higher toward the highs from here. Keep in mind, we were up, down, at least 2.8%, alternating every day this week until today. So it's probably a good thing that we respected those lows from last Friday and didn't spill right through them. But I'm going to kind of reserve any further kind of predictions of what it means, because I could find some positives without a doubt. Lower intensity selling on this go round, but it's hard to say that we've necessarily built in a margin of safety if we're going to get something like one of the more adverse scenarios economically coming out of this weekend.
Jill, what's your latest expectations on the S&P 500? And how do you make judgments when we see moves like we saw in the last hour there?
Right, yeah, I mean, it's definitely been a more volatile couple of weeks than you would think from just looking at the year-to-date returns on the markets. But we cut our S&P 500 target earlier this week to 3,100 for year-end, so about, 4%-ish upside from here. So, we think it's really going to be about picking your spots within the market this year. Certainly a lot of areas where the, proverbial baby's been thrown out with the bathwater in terms of opportunities. Well, I think, both at the single stock level as well as within certain sectors, financials are one that we've been overweight, where certainly lower yields have been a challenge. But, given the demand for dividend income, given how low yields are, financials is the sector that offers, the highest combined total of dividends and buybacks within the S&P. So that's one that we've liked. And utilities is another sector we've been overweight as a defensive hedge. So certainly some opportunities within the market, but we do think, there could be more room for downside risk. The market's still trading, about 16 and a half times forward PE. Long-term average is below that 15 times. We've troughed out even, 13 times at prior sell-offs. So could be some more downside risk, but, a lot is being priced in at this point.
How do you put a multiple on a market when there are just such big uncertainties as to the economic damage that this coronavirus is going to bring to the U.S.?
Right. I think, when we look at earnings, so we cut our S&P 500 EPS forecast to 4%. And when you look at, prior EPS recessions, usually EPS falls by about 20%. So that's sort of the bear case. But if we're not going into a recession, we do think at this point, given how much the market has fallen, 13, 14%, that obviously a lot of that is being reflected. And, there are spots within the market where we certainly do see more earnings risk. But, again, a lot of these areas are increasingly pricing that.
Very quickly, Mike, where is the market taken down earnings expectations to?
Well, the formal consensus hasn't come down that much. I think we're still looking at projected gains in the out quarters and things like that. Second quarter, I think, is still, formally speaking, we're looking for upside. So I don't think we've had enough information in terms of how business is proceeding from here to have a lot of change in the formal estimates. But if I look at the cyclical parts of the market, the market just hasn't waited for those estimate cuts. They've been taking them down in advance of that.
Dan, does the rally we saw in that last hour of trade change your perspective as to whether you should be buying or selling?
It's actually pretty bearish if you think about it, because I'm looking at the most important things today, that the 10-year Treasury yield closed at 0.76, down 15 bips on the day. It's down from 1.3 at its high last Friday, week over week. I'm looking at energy. I'm looking at crude oil down 10%. You're looking at, we just talked about the high yield. We're seeing those yields kind of blow out a little bit. There's nothing bullish about
selling stocks?
No, listen, my point is that, listen, we're back to where we were in October, okay? I thought the rally from late October when we broke out was stupid. What happened last year? We saw those three 25 basis point cuts, and we saw the Fed start expanding their balance sheet again by, 70, $80 billion a month. That's where that came from. So, we
also saw pretty decent economic growth.
We didn't, though, Sarah. We were actually below trend. GDP in Q3 and Q4 were not
better than a lot of people expected.
It was at the 10-year average at like 2.2 or something like that. And when we looked at the job gains, everyone's talking about this 273,000 today. That's well above what we've had over the last 5 years. But if you kind of normalize it, the 6-month trend is again back to the. So we wouldn't even have that. We wouldn't be having this conversation if the Fed didn't start cutting rates again and start expanding their balance sheet in the second half of last year.
Love your passion. Stocks wrapping up a very volatile week of trading. Bob Pisani here to break down some of the volatility. Bob, what a final hour there.
Yeah, you're not going to see the Dow move 3% almost in 25 minutes very often, but that's what happened. I just want to highlight the S&P 500 because everyone thought we were going to close at the lows, the February 28th lows. That didn't happen. Remember, that was 29.54 for the February 28th low. We now closed at 29.72. We got as low as, I think, 29.01 maybe on the S&P 500. Really a remarkable move throughout the week. In terms of Dow laggards, it's the worst performers today were usually for the week, too. ExxonMobil down 7%. I keep emphasizing 7.3% yield on ExxonMobil. That is remarkable. JP Morgan Chase down 7%. United Technologies down 3%. There were gainers, and we want to note that a lot of the consumer names did very well. United Health up 11%. There was a little politics involved there. Walmart up 9%. Procter & Gamble did well. Home Depot did well. Other consumer-oriented stocks like Kimberly-Clark all doing well. And remember, the market is now very susceptible to any kind of discussions about any kind of stimulus program. You saw what happened at the end of the day with Rosengren making comments. Bullard, basically the Fed has come out and done what is similar to what was done over in Europe a number of years ago, saying they will do whatever it takes, and you're certainly going to see more fiscal stimulus programs coming down the road. Guys, back to you.
Bob Pisani, thanks so much for that. Meantime, let's get uptown to Bertha Coombs at the Nasdaq for a look at the late-day comeback that took place there, too.
A massive comeback here at the end of the day. You know, I was looking at some of the major big caps. Apple was the only one that was up for the week, but at about a half hour ago, Microsoft was off about 5% for the week. Facebook also trimming its losses substantially here in the last half hour. Biotechs are definitely the outperformer, out for the fourth week in 5. The sector up about 3.5% for the week. The big winners, QIAGEN, which got acquired by Thermo Fisher, and the coronavirus plays, Regeneron, and also, that's the wrong ticker there on Barrick Gold, that should be Gilead Sciences. And then finally, the small and mid caps today, those sectors hitting a new low for the year, down further into correction territory, nearing closer to bear market territory, and that was led by lows in regional banks, in the airlines, and consumer stocks. Those small and mid caps under pressure and underperforming once again. Back over to you guys.
All right, Bertha, thank you. Jill, if you own one of those FANG stocks that Bertha showed, you know, they've been the darlings, big cap tech, sort of defensive, growth, all mixed into one, and you've done very well over the last few years. What do you do with them now? How vulnerable are they if this volatility continues?
Right. We've been equal weight tech, so we had downgraded it a couple months ago as we got into this year. You know, it's been one of the best performing sectors, not only, you know, last year, but for much of this cycle. I think now, you know, not only with the concerns around coronavirus and growth, but also with, you know, the election and potential concerns around, you know, big tech companies or monopolies, there's certainly some risks there. At the same time, it is one of the sectors in the S&P that has one of the cleanest balance sheets. It has a lot of, you know, bigger stocks that offer, you know, healthy dividends. So, you know, the secular growth internet stocks are the ones that, you know, tend to benefit when there's growth fears, and when growth slows down, that's when you want to pay up for secular growth. So, you know, in the near term, there's risk that theme could keep working, but, you know, overall, we would expect that if this is a temporary headwind and that, you know, profits growth does recover in the second half of this year, that's when perhaps the rotation into value that we haven't seen, we would expect could actually come to fruition.
Dan, is the market looking at PE multiples right now? Are you looking at PE multiples?
Well, this should be. For a name like Apple, which saw its multiple double last year, a year where the stock was up 100%, where they did not grow earnings, they did not grow sales, and they did not grow units of their main product, which is the iPhone. And they've just taken off their guidance for this quarter and possibly next quarter. So if you're telling me that Apple's trading at an all-time high multiple going back 20 years and all the uncertainty, here's another thing. Throw out a 5G upgrade cycle for Apple iPhone in 2020. It's not happening, okay? Not in a meaningful manner. So I just don't know why anyone would be paying 20 times for Apple right now, especially when the S&P is back to where it was in October, yet this stock is still materially higher of those levels.